Ladies and gentlemen, welcome to the Schindler conference call on the Q3 results 2022 conference call and live webcast. I am Sandra, the Chorus Call operator. I would like to remind you that all participants will be in listen-only mode and the conference is being recorded. The presentation will be followed by a Q&A session. You can register for questions at any time by pressing star and one on your telephone. For operator assistance, please press star and zero. The conference must not be recorded for publication or broadcast. At this time, it's my pleasure to hand over to Marco Knuchel, Head of Investor Relations. Please go ahead, sir.
Good morning, ladies and gentlemen, and welcome to the conference call for results as of September 30th, 2022. My name is Marco Knuchel. I'm Head of Investor Relations at Schindler. I'm here together with Silvio Napoli, our Chairman and CEO, and Carla De Geyseleer, our CFO. Silvio will provide an overview on recent developments, an update on the Top Speed 23 program, as well as on our priorities. And Carla will then lead us through the financials. After the presentation, we are happy to take your questions. Marco Hasler, the Head Area Controlling at Schindler, will be present for this as well. We plan to close the call at around 11:30 at the latest. With that, I'd like to hand over to Silvio. Silvio, please.
Thank you, Marco. Good morning, everyone. Welcome to this quarterly conference call. I'd like to thank also of you for your time. I understand it's a busy period with many companies announcing the results, including some today. So I appreciate how difficult it must be for you to organize your time. So we'll try to be as effective and clear as possible. So before we dive into the slides, let me just start with a key message. Since I took over this double role of Chairman and CEO, and had the pleasure of meeting you again last February, I said very openly that we are facing a difficult situation. I also said that we will fix it, and also said that this would take time. Accordingly, we initiated a process of change, confronting reality and focusing on what we call the vital few priorities. I've shared these priorities with you and we provide regular updates. Today, I must say that we have the first signs of improvement. At the same time, I'd like to stress it and say again, we still have a long way to go. With that, perhaps let me start by addressing the first challenge, which was the market. And it is never easy to provide a market update or a market statement, but probably in my 20 years in the industry, I must say this is one of the most difficult periods because things change so quickly. So if we start with the new installation market, and you have here a chart where we try to summarize the situation, it is truly in continuous flux. The year started with a solid market development all around the world, with the exception of China. In quarter three, somehow the same trend continued with some initial signs of slowdowns. Now, if we look at quarter four, I must say the situation is that China would continue to contract as it has since the beginning of the year, unchanged. But then the change here is that the rest of the world has also now started to slow down in a much more visible and I must also say quite rapid fashion. And this includes key markets such as North America, South America, and also Europe. On the other hand, the existing installation market, there I'm pleased to say in the service, we continue to have stable growth, both in units and in volume, thanks to the conversion. And then notably, the modernization pickup continues very strongly all over the world, including in China. We have a chance to discuss it later on in the presentation. With that first market outlook, and I'm sure we're going to come back to this also in relation to our order intake and address your questions. Let's move on to our challenges. And these are the same challenges, again, we presented to you since the beginning of the year. And today, I wanted to start maybe with a new format by first providing a general overview of all the challenges on the chart that you see here in front of you. Of course, there is an element here of qualitative assessment, but nonetheless, I thought it was important for you to have a very transparent view of the overall progress. So, before diving into the specific projects, let me perhaps add here the most important update. And that is that we stopped losing altitude. I say altitude in the sense of declining performance. We have started to stabilize the margins, and we have initiated a new trajectory where we now plan to undertake profitable growth on a steady level. At the same time, once more, we still have a long way to go. And that is visible on this chart. Because when I said it will take time, it was in February, beginning of the year. And now if you think of our book to build cycle, as you all know, following us and our industry for some time, we talk about 12, 18, 20 months, depending on the type of project, the type of units we sell. And so now if you relate this 12, 20 month proportion to the time that has incurred, we've had 9 months. So you could say we're about 1/3 of the way about there. And you can see this is reflected somehow in the chart that you see here in front of you. You will see we go through each one of the challenges in a second. However, once more, the point is that while we progress on individual priorities, individual aspects, we have to continue digesting the bad food that we ingested in the last 2 years. So sometimes in a company we call this the boa constrictor phenomenon, when you just have to digest the backlog while which then is reflected in the P&L, but at the same time preparing the results of the future. Nonetheless, again, I'm pleased to say that progress start to show. So let's now have a look at each individual challenge, starting with the first one of the foreign exchange. Now, that is another very volatile environment where, with the US dollar appreciating, we were very much looking forward to having finally some tailwinds instead of front winds. Unfortunately, the improvement in US dollar and to some extent also in the Brazilian reais has been wiped out by the steep decline in euro and also in the RMB. So again, this is the reality. We must deal with it. And at the same time, once more, we reaffirm our pride to be a Swiss company and in our deep roots in Switzerland. So in dealing with this reality, what do? Well, we focus on the efficiency of the Swiss-based quarter cost. As you can see here on the chart on the right-hand side, you see that this doubling down on efficiency has basically led us not only to a reduction in absolute value of the Swiss-based quarter cost, but also, and most importantly here, on a reduction of the percentage of revenue reflected in this cost. As you see, in 2022, actually, we were hoping to be even lower. Unfortunately, because of the initial slow pickup of the operating revenue, the percentage has not yet gone down as we planned, but we are definitely firmly resolved to continue reducing that both in cost and in percentage of revenues. Moving on to the second challenge, and I can imagine this is one that is the source of much interest, by the way, not only among yourself, also for us within the company, because this is absolutely key. And you can see what we've been driving from day one, and we openly said that, unfortunately, we were a bit slow in the previous 2 years in reacting, or even we should have anticipated inflation. We see that our efforts are now paying off around the world, with the exception, unfortunately, of China, where you will have heard from other industry players. Unfortunately, the situation makes for a very difficult environment to increase prices. But so far, I must say, you can see that we have high single-digit price increases in APAC, outside China. We have double-digit, very strong price increases in the Americas, both north and south. And this is, I think, something notable. We even delivered price increases in the EMEA region. Now, that's good news. On the other hand, the fact that China is so big, of course, somehow dents this whole effort on a global level. Nonetheless, if you look at the right-hand side, you see here the trajectory of the order intake margins. This has been going up. At the same time, when we speak about digesting bad food, you see that the backlog margin has, in fact, not improved. In fact, it even went down because the more and more some of the orders that were sold with the, let's say, overly optimistic cost base in the last 2 years, now they flow through the P&L, and so you can see that the backlog margin, in fact, is reducing. And the plan is once this margins in the new orders will flow into the backlog, you will see that also increasing and then overall impacting finally our P&L. Now, yes, overall positive, but I'd like here to stress 3 words of caution. Number 1, markets, and we discussed it a second ago, are slowing down. So the ability to continue increasing prices going forward has to be questioned. We definitely continue unabated, but that has to be said. The second, and again, I'm sorry to be like a broken record on this, but I think it's important, is that sales margins do not equate bill margins. So this improvement will take time, again, 18 months to flow through the P&L. Third word of caution, and this is not something which is very clear, is wage inflation is now picking up very strongly. Unfortunately, as material inflation declines, wage inflation is picking up. And this is true in unionized environment, but also in non-unionized environment. So pricing alone, and this you will come to that when you speak about a priority, will not be sufficient to reestablish better margins. We will have to work on efficiency, and if you don't mind staying with me for a few minutes, we'll address that later when we speak about our priorities going forward. Moving on to the next 2 challenges, 3 and 4, which we call supply chain and product complexity, and as of last time, we combine them together. On the left-hand side, you see a positive development. When we spoke last time at half year, we clearly highlighted the difficulty in producing in a factory to a large extent due to the lockdowns, in particular in China, but not only with us, also with some of our suppliers that in fact struggle to deliver their components all around the world, even in factories outside China, and hence the difficulty in on-time delivery, etc. The good news is that this has now started to change, and you can see that as you see that July, August, September in Q3, production capacity has been ramping up very, very strongly, even well above the capacity production that was delivered in 2021. So this is positive. On the right-hand side, you see this, digestion phenomena of the new orders versus old orders, but this time the perspective is between modular elevators and legacy product lines. And we spread, you remember, this is to do more about factory difficulty in managing multiple production lines in the lines. And the fact that, for 3 years there was a slowdown, this created this traffic jam in the factory. And you can see there is progress in that, first of all, in an order intake. Now the new pro lines are about half year to date. But then in the order backlog, there is then progress as you ramp, the production capacity ramps up, you saw on the left-hand side. But it has to be noted that legacy products still constitute 2/3 of the total order backlog. So going back, not only a question of margins here, but also a question of production efficiency in dealing with multiple product lines at the same time. Moving on to challenge number 5, and then this may be one that we spend a bit more time, which is China. And of course, China is so important that it affects the whole overall world market, as we saw before, on the NI market and on the pricing level. Now, you can see on the charts that we update for you on a regular basis, first of all, that the floor space sold continued to decline across all city tiers, and we now reach the levels of the latest crisis of 2017. What I find even more of immediate relevance for our industry is the housing inventory on the right-hand side chart. And then you see the crisis level is such that we now came back to the peak levels of the 2014 crisis in all 3 tiers. Now, what could be a positive thing is that you can see there is, based on official data, a sign of an inflection of the curve. And the key question is here, does that mean that we hit bottom? Or could it be that this is a temporary one and then we'll continue increasing inventory going forward? These, of course, we all hope that would be the former, i.e. that this would be the peak of the crisis in terms of housing. But I must say, for the moment, the estimate for the Chinese NI market is still of a contraction in between 15 and 20%, which we're not here now to provide forecasts, but based on latest indicators, including the ones you see here, is likely to extend into 2023. Now, what does that mean for China? And of course, there is a lot of doomsayer, and of course, there are also many other aspects of China, including geopolitics. But we're not going to go into that. But as far as our industry is concerned, and I know it's well known, but sometimes it doesn't hurt to restate the reality, is that in spite of this major contraction, China still remains by far the largest new installations market in the world. You see in the Pareto chart here on page 10 that China still accounts for 63% of the world market. Well, of course, this is in units. Last year it was 66. But most importantly, you see that the second largest market, India, is, depending on how you measure it, about 1/10 of the size of China. So we need to stay very close to China. And then you see that the other countries thereon are actually even a smaller fraction of the world, but also the China market by itself. So again, not only is China the biggest market in the world, but we believe, moving on to the next slide, that China still has major potential for growth. And why do we say that? You see on the chart, and again, it's sometimes good to see it on a chart, it is the highest concentration by far of mega and large cities. I'm talking here of cities above 10 million, between 10 and 3 million of anywhere else in the world. And as you may have seen in some studies by the EIUs and other independent organizations, these cities are still growing due to the continued urbanizations in China. Now, if you look more granularly at our industry, and you look now at the right-hand side, you look here at elevator density measured by number of installed units per 1,000 people. Some of you may remember that when I was CEO in 14-15, actually we used the chart on a regular basis to look at potential. And you can see that China here is still way behind South Korea, Germany, Japan, much smaller markets than China. And China, on the same chart, you see, had a tremendous progress, as one expected, over the last 11 years, but still has wide range to grow before it reaches the levels of South Korea. So, all in all, if you combine the two factual data points on this page, you see that China, medium term, long term, is still expected to continue growing. And this is true for the new installation, but it's also true for the existing installation market. Moving on now to the next page, on page 12, where you see that the figure on the left-hand side for the China install base, or the overall number of units of maintenance, elevators and escalator, is about to reach 50% of the world's total. And incidentally there, you can see that if the market over the period 17-21 grew by 12%, Schindler growth of portfolio in the same period was above market in the order of 15%. Now, much more to come. And this is not only a unique opportunity, but one could even argue it's historic in size, and one that must be seized. So how do we go about this as Schindler? We clearly, as a first big block, we have to invest in technology. And you may have heard some of the speeches at the CPCC Congress happening at the moment. You see there is a lot of talk about technology, a lot of talk about how China continues to invest in technology. And this is true in the whole economy, including in our business. And so the authorities are now promoting, and this is, I'm sure, known to you, a new program to promote safety via remote monitoring. We are supporting them in that, running pilots. And then, of course, there's a whole topic about connectivity and digital services. We'll come to that in a second, which also not only drives portfolio growth, but also a differentiation versus local players. Then there is the whole aspect of the more classic approach, which is regaining units that we have lost on the basis of differentiation and better quality, but also doing that to some extent by acquiring independent service companies. And there are several of those in China. But again, the focus there is to look at density, efficiency, quality, to make sure that we overall gain efficiency as a whole. Then, of course, there is the modernization in China, because after all this growth over the last 20 years, there is now up to 1.5 million units which are aged. So, which are, especially in view of the high usage in China, they're up for modernization, which constitutes a huge opportunity. And for that, we are introducing a new modular platform. You'll come to that. It was one of the programs that we have in Top Speed 23. And then there is, of course, a big opportunity by combining this with sustainability solutions to reduce the carbon footprint of buildings and of our customers. So this was an update on all the challenges. China is a key one, but again, there are big opportunities. Now, over the last three presentations, we stopped here and then we started speaking about financial results. Now, I also meeting you and also through exchange we had over email, we understand there was a strong demand, which I understand very legitimate, to get a bit more color about how we operate, what are our priorities. And so we clearly, now that we start stabilizing our performance, I think it's time that we also dedicate our resources to provide you with this update. And so here I would like first to provide an update on the Top Speed 23 program. You remember we announced it and we explained that it was something to build the future of Schindler with substantial investments. So today we'd like to provide you an update of where is this overall Top Speed 23 program. And then I'd like to move to page 14. And I'm pleased to say that overall, when one speaks about the Speed 23, we have progress. We have a further focus on which module of the program address our immediate priorities. And third, most importantly, that some of these modules already start providing, paying dividends. So let's have a look at the summary here. And again, you see the subtitle speaks about realigning with operational priorities, because yes, when the year started and we took stock of the situation, we said, yes, this is very important, but let's make sure that now we apply the same aspect of efficiency and focus also to this program. And so the 6 modules you see here. Some of them are either completed, or close to closure. The first one is the one on new installation growth in selected strategic markets. And you can see part of the immediate payoff is what you've seen in improvement in margins, in a refocus in specific segments and markets where we can be the most successful. Another one that is very close to closure is the bottom one, which we call procurement excellence, which I would say it was about time, I admit. But now, of course, in confronting the challenges of inflation, or now the quick changes in raw material changes, we now have an organization that is set to address those and yield bottom line benefits, but also quality and safety. Is it not yet completed? We do have some staffing to be completed by year end, but clearly by year end this will be completed, and we already start seeing some of the benefits. Now, maybe moving to the third one there, sustainable modernization solutions. I spoke about China as a unique opportunity, and there you see we decided, instead of looking at mod solution worldwide, we saw we have this huge opportunity in China. So again, we refocused the project only on China. That, in fact, brought us back a bit in terms of progress, because we had to relook about how we could really make sure that we had the right product for China using a modular platform. But we anticipate already EBIT impact as of next year. Then you have 2 that are more long term. They were so planned, because even if they will be completed to some extent by end of 23, the EBIT impact as planned will take a bit longer. And this is the digital twin, and this new products for the market coverage in segments where we have been less present. Digital twin, you see, we are much more advanced with escalators. This is the one we started with, where our factory and R&D modules are about to be launched beginning of next year. On the elevators, on the other hand, we started later as planned with a pilot phase, where then we will focus much more on the field operations to make sure how we can apply this digital technology seamlessly with our other tools that we have for the NI, for the installation and service as well. Finally, and I mentioned it last because there I'd like to spend a bit more time, you see that the connectivity, which is the second module here on this page, has progressed very well. We have now 25% of our portfolio, which is cloud connected. I like to stress that point. It's cloud connected. So we do not include here the old tele alarm or all these analog lines that we used to have before. These ones are there. And if you add those, the percentage is much higher. This is really, with Schindler ahead, cloud-based, with the whole software stack, edge computing, everything which we need to have in order to provide a unique digital service to customers. And so this has progressed well, and is starting already to have an EBIT impact this year. And maybe to elaborate, I'd like to move to the next page, on page 15, where you see some key numbers, and I see some of our other players in the industry presented the case, and I think it was time we spoke about ours. And I'm pleased to say that the whole topic about connectivity in the elevator and escalator business is now a proven model. And so again, you see here 25% of our portfolio cloud connected. And what are the benefits immediately when I spoke about EBIT impact already this year? First of all, look at the right hand side on the more classic aspect. Our portfolio loss rate, the number of units in maintenance that we lose to competitors, is dramatically reduced. I'm talking about 1/2. So this, I would say, is even beyond some optimistic scenario. That's exactly what I was hoping for when we launched it back in 16, and I'm very pleased with this development, and that's now a fact. Now, the other one on the right-hand side is that you can see, thanks to the data connectivity, the type of early detection of defects, of callbacks remotely, thanks to our technical operating centers that we have in all key markets, which are on top of our normal call centers, we could reduce on disconnected units callbacks by 30%. Now, and the 30% is compared to non-connected units. I know that some others have published higher numbers, but if we now include all the improvement of callbacks that we do as part of our quality effort, I'm talking about a much higher percentage. But this is simply the difference between connected and non-connected, and this in itself is a tremendous result. So I'm talking about a one-third efficiency gain. Now, on the left-hand side, you see now the new areas of business that can be open thanks to this connectivity. And I'm very pleased to say that 50% of the connected units now provide revenues. So we call this the monetization rate, which is an important number, especially because, to be very clear, from a marketing point of view, perhaps I have to admit we still have some way to go. This is a bit of a change mindset, but also competencies throughout the organization. But this, of course, shows for very substantial potential. And then you may remember I presented it in Q2. This whole aspect of green maintenance module that now we actively sell in some strategic markets where, and this is now certified by TÜV. You may remember also we presented the last time. In fact, the overall footprint for our customers, so it is for us scope 3, for them is scope 2, for buildings due to elevator maintenance goes down for as much as 99.5%. If all the aspects are applied, including electric vehicles, etc. So that is, I think, a very important element, and again, showing how this top speed 23 investment was absolutely right. You can see on the next page we provide a bit more color on explaining how this sustainability aspect is being addressed and how you reach this 99.5% reduction potential if you apply the remote maintenance, less physical visits, and that thanks to the efficiency in the higher uptime, but also, of course, that then whenever we have to go, because legally we still have to go a number of times, then this is done with electric vehicles. That was the top speed 23 update, and we continue providing you there. Maybe we can also address it if you like in the financial aspects. But before passing the word to Carla de Geysler, our CFO, I also wanted to address another question that was asked by you, which is, how do you operate? What are your priorities? And as you can imagine, we have been addressing that, and since the beginning of this transformation, this is something that we have drum beaten across the organization, starting with the leadership on a regular basis. And if you now move to page 18, you see our priorities that I was saying shamelessly, maybe unoriginal manner for those of us that studied marketing at business school. There was an expression called 4 Ps. Well, I think 4 Ps applies very well to us, except these are different 4 Ps. And the priorities we've had are 4 Ps: people, products, performance, and planet. And this is something that everyone in the organization now gets accustomed to. Everything that we do has to fit in one of these 4 boxes. Otherwise, we put it on hold or we just simply scrap it. Perhaps giving some color within the different boxes. You see under people, the first point is front line is the bottom line. Let's not forget 2/3 of our workforce are field people, technicians, installers, project managers. They're the ones that carry the Schindler brand. They're the ones that are the most important people in our company. So the idea is that all our resources must be driven in order to support the front line. Anything that doesn't should be put as a second, third priority, and therefore, by definition, put on hold or scrapped. We also have a big element of culture, which then addresses the change management. We call it back to basics because I think we learned the hard way that we must avoid by all costs this gap between narrative and reality to make sure we confront the facts head on and simply deliver by sticking to our original values. There is, of course, a topic of inclusion and diversity and the fact that, we definitely have to upgrade all our teams to make sure we are prepared to perform. with a quality second to none in our industry. The aspect of products, we already discussed it to a large extent. The topic of profitability in new equipment business, the idea of modernization growth and profitability to profit from the unique opportunities today. Then, of course, we couldn't speak about products without addressing service, which is the essence of our value creation going forward, with emphasis on efficiency. And then, of course, the topic of supply chain, where we addressed it as part of our priorities. There is the need of after we fix the issues today, once we've done it, we need to look at a complete overhaul, which we're already starting to address. On the performance, I'd like perhaps to stress the first part here, which is a formula that I think people in our organization are now tired of hearing me repeating like a broken record. Pricing plus efficiency has to be bigger than inflation. Again, pricing will not be enough to offset inflation, all the more now with the wage inflation picking up. So it's about accepting inflation as a reality and driving the organization to stay above inflation with a combination of what people can do on pricing, but making sure we also drive efficiency to stay on top of it, to stay ahead of it. Then there is the aspect, of course, of strategic markets. Of course, China is one of them. But the idea is what? Is that one size does not fit all. We're markets with a dominant position where we are very profitable, and there we have to continue growing. We have to make sure that we not only defend, but they build on these positions. Then there is a second group of markets where we are solid, but with a profitability that is on par with the group minimum requirement. And these markets can only grow if they improve the profitability, they either keep or improve the profitability. Then there is a third category, which are markets where we are way behind in profitability. And in those markets, the message is clear, and it is clear now, it'll be even clearer now as we go forward with the objective in 23. They can only grow if they improve the profitability. So this is the three-tier approach we apply worldwide. And of course, we shouldn't forget that at the end, the success is measured not by how we meet our targets, but what our customers think of us. And so this is another message that is constantly driven across the organization. Finally, and it could have been mentioned further, the aspect of planet. You remember I presented it last time, so this time we have less of that. We have a ESG roadmap, the first one of which comes to fruition in 22. We're working incessantly to make sure we can deliver. There are some challenges, in particular in terms of electric vehicles, but nonetheless, we are doing everything we can and more. And we have a new net zero CO2 target certified by a science-based target organization, on which now we are making plan, executing already, driving. And finally, what we call Industry 5.0 is the application of the new circular economy to the elevator and escalator model, which we are certain will provide unique opportunities and not only for our shareholders, but also for our contribution to the planet. In conclusion, maybe takeaways before I pass the word here. We have stopped losing altitude by focusing on the priorities we established at the beginning of the year. We have stabilized our business and started a new trajectory towards profitable growth. At the same time, it will take time before we close all the gaps we identified. We have a long way to go, but our resolve is absolutely unabated. Thank you, and with that, I'd like to pass the word to Carla De Geyseleer, our CFO. Carla, please.
Thank you, Silvio. Good morning to everybody. You might know that I started here my role as CFO 7 weeks ago, and without any doubt, I'm very much looking forward to engaging with you and to meeting you in person at a certain point in the future. Before diving into the details, let me first make some high-level comments. Third quarter results show initial signs that the corrective measures that were implemented throughout the year are starting to pay off, since the revenue recovered in the third quarter and the profitability clearly started to improve. Order intake remained under pressure due to globally slowing growth and our focus shift from volume to value and margin. We see definitely an encouraging trend in continued order intake margin development. As pointed out already, the complex mix of challenges persisted in quarter 3, and eventually they will still impact our overall results. Nonetheless, we narrow the bandwidth of the revenue guidance and confirm our net profit guidance for the full year 2020. The following 2 slides show the key figures for the third quarter and for the 9 months year-to-date respectively. And as I mentioned, with the exception of order intake and cash flow, the third quarter 22 results show encouraging signs of recovery, particularly with respect to revenue and margin. Even more importantly, we recorded a progressive trend throughout quarter 3. Adversely, the year-to-date 22 key figures reflect a very weak second quarter results, which were particularly impacted by lockdowns of our China operations during several weeks. Moving on to the next slide, I'd like to present you the order intake development. As you can see here, in the third quarter of 22, the order intake reached 2.7 billion Swiss francs, corresponding to a decrease of 8.5% and to a decrease of 5.9% in local currency, and this as a result of our focus on sales margin and a slowing growth across the globe. In the first 9 months of 22, the order intake reached 9 billion Swiss francs, corresponding to a decrease of 0.8%, but equivalent to a positive growth of 0.7% in local currencies. Organic growth amounting to 0.4%, acquisitions contributed 0.3 percentage points, while the FX had a negative impact of 1.5 percentage points to growth. The next slide provides you with an overview of order intake growth by region and product line compared to the first 9 months of 21. An order intake here represents all product lines, so the new installations, the modernizations, the repair and the maintenance. The Americas and the EMEA regions grew, while the significant contractions of the Chinese new installation markets weighted negatively on Asia Pacific. So overall, the new installations declined, while maintenance, modernizations and repair business continued to grow nicely, resulting in an overall positive growth. Since the beginning of the year, the order intake margin has been continuously increasing, and this is also reflected here in the value development, which outgrew units development and is the result of successfully implemented price increases and our ongoing focus on higher margin projects. Our portfolio of maintained units increased by more than 4% year on year, and the order backlog was 1.2 percentage points higher, increasing to 9.9 billion Swiss francs. Backlog margin stabilized in the last quarter and declined by less than 100 basis points year on year, reflecting cost inflation, product legacy and portfolio rotation. I continue now with the revenue development on the next slide. And obviously, I'm happy to share here the positives first. The third quarter of 22 showed an accelerated growth due to strong backlog execution throughout quarter 3. Revenue increased by 5.6% to 3 billion Swiss francs, corresponding to an increase of 7.9% in local currency. So encouragingly here, performance was almost evenly distributed across all regions, but also across all the product lines. In the first 9 months of 22, revenue reached 8.3 billion Swiss francs, equivalent to an increase of 0.3% and 1.7% in local currencies respectively. Organic growth reached 1.1%. Acquisitions added 0.6 percentage points, while FX had a negative impact of 1.4 percentage points to growth. The increase in the EMEA and the Americas regions was offset by a decline in the Asia Pacific region clearly resulting from the situation in China during the second quarter of this year. Growth in new installations was negative, again, particularly due to the situation in China. Modernization was weak in Asia Pacific, while repairs and maintenance remained solid, and this across all the regions. Now the next slide shows you the development of the EBIT adjusted and the EBIT. And the inflationary pressure, product legacy, semiconductor shortage, supply chain issues, and restructuring costs persisted in the third quarter. However, I would like to draw your attention to the positive trajectory of performance, narrowing the gaps year on year. EBIT adjusted in the third quarter of 22 reached 272 million Swiss francs, which is equivalent to a decrease of 11.7% and a decrease of 8.8% in local currencies. In the first 9 months of 22, the EBIT adjusted reached 738 million Swiss francs, decreasing 22% and 20.2% in local currencies. And as a result of this decreasing profit, cash flow from operating activities significantly weakened. And in addition, the weakening was driven by substantially increased net working capital requirements, particularly reflecting challenges in our supply chain. Cash flow from operating activities declined 67.5% to 77 million Swiss francs in the third quarter of 22, and to 376 million in the first 9 months of 22, equivalent to a decline of 60.8%. I've been now here with the company for a few exciting weeks, and obviously I knew when I arrived that the team had been analyzing the situation and implemented a whole list of corrective actions. And based on what I've seen so far, I will continue building on these, and I will focus my attention on 4 areas which are very much in line with the challenges and the priorities that were presented by Silvio. Pricing, efficiency are top of mind, since these 2 at least need to exceed inflationary pressure to further improve our profitability going forward. And in view of slowing growth, efficiency across the organization will even gain even more in importance, and we will therefore further analyze all our processes to unlock additional potential that we might have. This applies also to our supply chain and the procurement challenges where performance needs to be further improved. And at last but not least, I also strongly focus on the net working capital management in view of its most recent development and the economic environment. With this, I would like to turn now to the outlook for 22. Schindler expects the markets to further slow down globally, and assuming no further lockdowns or other unexpected events, Schindler foresees revenue growth between 0 and +2% in local currency. And we confirm the net profit guidance of between 620 million and 660 million Swiss francs for the full year 22. Let me now close with a bit of a personal note. First of all, I'm very happy I joined Schindler, and I'm very much looking forward to working with my colleagues on further growing the company profitably and sustainably. And I would like also to thank all Schindler employees around the globe for their hard work and their dedication to this encouraging performance in the last quarter. And with this, I hand back to Marco.
Thank you, Carla. We are now happy to take your questions. I would like to ask you to limit yourself to 2 questions only, given the limited time we have available. Thank you very much. With that, I hand back to the operator to start the Q&A with the first question. Sandra, please.
We will now begin the question and answer session. Anyone who wishes to ask a question or make a comment may press star and 1 on the touch-tone telephone. You will hear a tone to confirm that you have entered a queue. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Anyone with a question may press star and 1 at this time. The first question comes from Lars Bronson from Barclays. Please go ahead.
Yes. Hi, good morning, Silvio, Carla, Marco. Thank you. I will restrict myself then to 2 questions. Thank you for the candor, Silvio, and the additional detail you're providing. My 2 questions would be, 1, on your slide 7, right-hand side, the chart there on OR margins, and secondly, slide 8 on the left-hand side, your region 2, which I assume is China. The first question on slide 7, it's obviously helpful to get your new installation orders received margins ex-China. Guess it would have been even greater to get it including China. So maybe I can ask where China new installation order margins are, and whether this chart, had it included China, would also have shown an improvement sequentially on orders received margins. In other words, is rest of the world more than offsetting the weakness you're seeing in China new installation orders received margins? That's my first question, please.
Lars, thank you. So yes, we reflect on slide 7. Very good question, I understand. So to be clear, the margins in China, in fact, are stay flat. So the trajectory you see, in fact, is we actually even thought about China and non-China on this, but if China stays flat, in fact, it doesn't alter the change. So to your question, yes, the net effect is positive, even offsetting China. China, we've seen in the last 2 months, we've seen a slightly big, but very, very limited, which doesn't have, if you want, an impact so far. And so it's really consists of, looking at the right project and finding them. But the situation is in China, as you heard also from other sources, is one it is. So I hope this answers your question.
It does. If I can sneak one related into that, I mean, if the industry doesn't appear to be seeing better pricing now, I can only assume the pricing gets worse in 2023 in China as steel prices move lower and volumes continue to decline. At least that's my assumption. High level question then is, if you accept that assumption, why would China new installation pricing for the industry not mirror that of, should we say, the last major downturn in 2015-16 when industry pricing was down high single, low double? I'd be keen on your reflections on that.
Yes, thank you, Lars. It is a question that you can imagine also interests us immensely. I must say, having, as you probably know, lived 6 years in China, in Shanghai, and having faced the situation, exactly this kind of trends, I think the assumption you say that in view of the reduction in raw material, the price may go down in China. That is, I think it's a rational observation. You may even add to that, and I don't mean to be too gloomy, that with the market shrinking, which I think for me is the key element here, then of course the likelihood of pricing further declining in view of the excess capacity in the market is also very much a fair assumption. So the key there, and then on top of that, there is also wage inflation. Now in China, that is less of an issue. However, there are pockets, some of the cities we mentioned, where this is one. But that, I think that, if anything, is easing a bit in China at the moment. But overall, I think any assumption of improving prices in China, as much as we never stop trying, is probably still unrealistic. So I think I would support your observation here, Lars.
A second quick one, if I can. Slide 8, left-hand side, year-over-year deliveries. Again, region 2, which I assume is China. September is reversing that recovery you've seen since April. We heard Corner also flag, of course, in their pre-release, the lack of site progression among developer customers in China. They're effectively deferring deliveries. Should we continue to see that sort of sequential downtrend in Q4? Have you already seen that in October? And related to that, if I can, how do you assess the broader risk around order cancellations in China? Thank you.
Order cancellation as such, so far is not a big deal in China. No, order cancellation is not. The question though is side delays. That is one topic. But cancellation, no, we do have, as you saw before, you heard from Carla, the topic of bad debt, which is one that is can affect, depending on the stage, the project itself in view of our paying schedules. But at the moment, we don't see order cancellations, I must say. So the backlog being still solid, we do not see any immediate risk of sudden interruptions. The key, of course, is going forward, depending on the order intake, how can you keep the right backlog at the right level to then produce in order to generate the profit results. But we're talking about now further down the time, and we're working very hard to address that too.
And sorry, just
Lars, we lost you.
sequentially.
Could you repeat? Sorry, there was a moment of interrupted communication. If you don't mind repeating the question, please, Lars.
Sorry, one last one, and then I'll go back in line. I was just curious on that slide 8, where we see the region 2 again. I assuming that's China, that September is reversing the recovery since April, and I think it's a key question because we see deliveries being deferred in China. So I'm just curious as to whether you've seen that sequential downtrend continue in October, and is that your expectation that will continue to slow down in the fourth quarter, meaning deliveries in China, please?
No, not at the moment. This is more of a big push in August. You can see 100% is already a big delivery in a factory. So barring barring another lockdown, and as you read, there is a few scares happening here and then. Barring a lockdown, we don't see the risk of a further slowdown in delivery. This is, if you want, a monthly trend. We don't see this as being an ongoing trend going forward.
That's clear. Thank you.
Thank you, Lars.
The next question comes from Andre Kukhnin from Credit Suisse. Please go ahead.
Good morning. Thank you very much for taking my questions. I'll stick to 2 as well. First one, just on top-line guidance for the year, given that we've got only 1 quarter to go. You seem to be implying quite a slowdown in the run rate in the fourth quarter with the midpoint or even at the top end. I just wanted to check if that's kind of degree of conservatism built in because of what you mentioned, potential lockdowns, etc., or is this what the order book is telling you?
Andre, I thought you and your colleagues will pick up the point. I do think you know us. I mean, there is an element of conservative approach precisely in view of this, frankly, uncalculable risk of possible lockdowns. So it is a conservative.
Very clear. Thank you. Oh, sorry, Silvio, didn't interrupt.
No, but Andre, we lost you.
We take the next question from Zhang Yifang from Goldman Sachs. Please go ahead.
Morning, everyone. So my question is actually also related to site delays. So you comment on China, but what about Europe and US? Because Connie mentioned that they also see slow progress on site delivery for US and Europe. That's the first question. So I'll also second after this one.
Thank you, Chang. No, at the moment, we don't see site delays. If you look at the immediate, I would say next 2 quarters, no, we don't see that. But there are indications, if one speaks to some of our customers, of them probably it's more a question of them making less investments going forward. But the ongoing project backlogs is going as planned in Europe.
Makes sense. Thanks. And the second one's more on the margin target. I know you don't probably give a specific one, but where do you see potentially immediate term your margin's going to be given the progress in your programs? Is that going back? We can think of a level like back in the last 5 years, about 11 to 12%. Is that a reasonable assumption there?
I think what well, we just say we don't give a time by when this will be there. I think in this uncertainty, we're not prepared to do that. However, I think the figure you mentioned, since we said our goal is to close the gap with our competitors, this is the minimum target we could, as you can imagine, legitimately give ourselves.
Thank you.
Thank you.
The next question comes from Rizk Mahdi from Jefferies. Please go ahead.
Yes, hi. Thanks for taking my question and the details provided today. I'll start with the first one on China. So Silvio talks about the potential decline of 15 to 20% this year, and potentially a decline into 2023 in light of the NPC announcements and perhaps a lack of stimulus, which has always been the case in previous downturns. Whenever we hit these levels, we've seen China coming in with big stimulus, which we're not seeing now. Maybe if you use your sort of experience and your crystal ball, what would you think would be the sort of market performance next year? I'll start here.
Thank you, Rhys, for the question. Gosh, I'm afraid the crystal ball, I lost it some time ago. But to your question, I said before that at the moment we are now triple checking, triangulating the data, even with external sources. But the likelihood for next year in China is similar market contraction as this year. Now, this is maybe the short and simple answer. If you allow me, one related question could be, how long will it take for the market to come back? If you look at the crisis that we suffered in 2014, and I was very much very close to it back then, and you look at the chart, it took 2 years to come back. So now, China, of course, the economy is not growing at the pace it used to back then. So you probably cannot apply this one-to-one. So just top of my head, I would say maybe it would take definitely more than 2 years. Though in the meantime, you saw what the data we presented before. China will remain a huge market. So this is all I can say for now, Rich. I'm sorry I cannot provide more color, but does that address your question?
Yeah, that's helpful. The second one is on wage inflation and how we should think about it for next year. So I think this year you're having something like 140 million. I guess that's essentially coming from the US. If you could just update us on how sort of negotiations are ongoing in Europe and other regions, and how should we think about that sort of wage inflation headwind next year? Thanks.
Okay, thank you for this question. Carla, would you like to address the question?
Yes, with pleasure. Obviously, we take into consideration that the wage inflation will be picking up. Silvio pointed out already. And even I would say if we need to go a bit more specific for the full year, we are actually counting on more than 100 million for the wage inflation. And obviously that will, further also, increase in 23.
Okay, thank you.
Thank you, Rich.
The next question comes from Martin Hüsler from ZKB. Please go ahead.
Good morning, and thank you for taking my question, and thank you for the interesting slides deck. My first question is turning around the one-off costs that you usually deduct, and it looks like that after 9 months, those were kind of pretty much lower than we were expecting. Can you give us some light why were TS and also restructuring costs below our expectations, and what is the full year outlook regarding those costs? That was my first question.
Yeah, first, okay, sorry, Silvio, I know you want. The first topic is definitely the top speed program. As Silvio pointed out, we have been realigning really the program there. So that resulted in the fact that we are actually foreseeing that we will spend less on the top speed program as a whole, and also obviously in the year 22. That is one of the big elements there.
Would you share a number with us, maybe?
Yeah, definitely. I would say on the full year, we foresee to spend approximately 65 million on top speed.
Okay. And the restructuring costs will stay on the Q3 level also for the last quarter?
Yeah, no, for the full year, actually, for these costs, we foresee around 50 million.
50. Thank you. And then my second question, maybe a bit more strategic, but also turning to China. And you were mentioning and showing the potential that you see for service and modernization. What margin at the moment do you achieve in China, let's say for new installation, but also service and modernization? And probably you won't give us a clear number, but if you compare it to the group average, can you give us there some more insights? And what trends do you expect for the margins for, let's say, service and modernization in China in the future?
Good. I understand your question. Again, you're right to understand we're not going to give exact numbers, but we definitely can give a relative answer. Marco, would you like to address this question?
Yeah, so EI margins are lower than group average because we have a very, let's say, significant regulation in China of 25 visits a year, which is very, let's say, limiting our ability to drive efficiency. However, there is also progress in terms of using connectivity to replace physical visits, etc. So we expect that we can drive this down the road, but it's clearly below average of group margin in EI.
You also asked about modernization.
Modernization is aligned with group.
Does that address your question?
Yes, thank you. And just to help me to remind that in new installation, it used to be always more profitable in China, but I think due to the pricing pressure we see and obviously the market downturn, is it now below average in China?
That is correct. It's below average in China for the Schindler brand. It's different for dual brands.
Very higher. Okay.
Thank you.
The next question comes from Aurelio Calderon from Morgan Stanley. Please go ahead.
Hi, good morning. Thanks for taking my questions. I'll take them one at a time, if I may. So the first one is around one of your comments you were making on the order intake. I guess of the 6%, 5.9% decline that you've seen in the order intake, how much of that do you think is due to end market weakness itself, and how much do you think is you just staying away from projects which don't meet the margin criteria?
Broadly, excellent question, Aurelio. Thank you for that. Broadly, it's about 50-50. The probably why in China is mostly due to probably the market decline and the thing, but there are also other parts of the world where, frankly, especially when talks about large projects, there are some that we, I would say, very intentionally decided to step away from in view of the low profitability. By the way, not only in NI, but always EI. We look at these things always, we call it wall to wall. So we look at the factory, at the margin in the field, but also the future revenue. So it's about 50-50.
Okay, that's great. And my second question is, sorry to go back to China. You've mentioned overcapacity in the industry, and we can see the numbers. But I understand that you also have an export business from China. So the question would be kind of two sides to this question. One, would you expect to see a major restructuring in your China business, so that's this new normal, or do you think that export market could still somewhat compensate for that weakness in the domestic market? And two, if you can remind us how much you export from China and how much is just local for local. Thank you.
Okay, good. So there are three elements of the question. Let me address them one by one. Let me start with the last one. It was about export, right? As you know from our manufacturing setup, we have factories in India, we have factories in North America, South America, Europe. Actually, we have several. So our approach was always to manufacture where the market is. Contrary to other players, we never use China as the global export hub. Nonetheless, and I refer to that because of course, the Asia Pacific proximity, China for us was mainly used as an export hub for Asia Pacific. Plus, there are some component suppliers that actually are present in China, but then we also often channel through our China supply chain. Overall, if you don't mind, allow me not to give an exact number, but I would say a fraction of our production capacity in China is dedicated to export, but the large majority, is dedicated to production in China for the domestic market, which, as we saw by size, definitely justifies it. Second question is, how do we plan to adjust for the China market? There, I think we need to be realistic. A market that declines 15-20% 2 years in a row, if that is the way it is going to be, calls for an element of restructuring. Now, you use the word major. Now, whether it's going to be major or a radical of a resizing of the China presence, for me, and we discussed it openly in the team, I think is becoming more and more a very probable likelihood, if not an urgency. Does it mean that that it has to be exaggerated? No. As you saw, the figure in China still justified for a big presence and an important market, but it's not the same size. And so when you saw this chart we presented, it was, I believe, on slide 11, on identifying cities with most growth potential, but also with portfolio density. This is the type of approach we're having. And this note, of course, as you know, the China system also has agents. The idea is to focus our sales network and maintenance network in a more concentrated area where you have, a more sustainable business in terms of margins, new installation, but also in terms of service conversion, service density, etc. This will be the essence, and I'm sure we'll probably talk more about it in February when we present the plan for the year.
Great, thank you.
Thank you, Randy.
The next question comes from Vlad Sergievsky from Bank of America. Please go ahead.
Yes, good morning, and thanks very much for taking my question. I have one left on the cash flow. So on my numbers, to get to 77 million of operating cash flow in the quarter, you could have faced a working capital headwind not too far from potentially 200 million, which obviously is a big number for one quarter. So what was driving a sizable headwind? Is it unwinding prepayments or high inventories or unbilled receivables? And are those headwinds related to any particular region at all? Thank you very much.
Thank you, Vlad. Carla?
Yeah, definitely. Yeah, it is mainly related to the inventory build-up, and obviously, that hangs together with the supply chain issues, that we are working through. Yeah, that is actually the main reason.
And is it across the region? So again, any particular region is kind of a highlight there?
It is actually spread over the whole portfolio, over all regions. Yeah.
And if I may follow up on that, would you expect those inventory builds to start reversing perhaps in Q4 or in some point soon, or that's too early to call?
Yeah, we definitely expect an improvement in quarter 4.
Yes.
Understood. Thank you so much.
At the same time, I'd like to draw attention to the chart on page 8, where you see that I call this traffic jam in the factories between legacy products and new products, still not being resolved. So, Carla is right. We definitely want to make sure that we continue producing at the rate we showed on the same chart on the left-hand side. However, I think we need to be realistic about the speed at which we can really go back to the I'm not going to say glory days, but to a time that we can really run the factories with the level of efficiency that we aim for. And maybe final point, one of the lessons from the last 2 years is also how to run factories by combining efficiency with risk management. That means, and I'm sure you probably hear it from other companies now, is that the whole idea about just in time will definitely remain, but the level of just in time minimum inventory most likely will change. Now, but you rightly spoke about a trend, so the trend definitely should improve. Let's only keep in mind what is the ultimate point we could reach. Does that make sense?
Absolutely. That's very helpful. Thanks very much, Silvio, Carlo.
Thank you.
Thank you.
The next question comes from Martin Flückiger from Kepler Cheuvreux. Please go ahead.
Yeah. Morning, gents, and morning, Carlo. Thanks for taking my question. Actually, I've got two as well. Firstly, on modernization, seems to be quite a bit of volatility in your order intake in modernization. Just looking at the last few numbers that I've estimated based on that slide. What is it? 2024, I believe, yeah, in your presentation. Just wondering what's behind this huge volatility, yeah, because looks like Q3 modernization was again down. Or am I missing something or misinterpreting something here? That would be my first question. I'll take one at a time.
Thank you, Martin. Good observation. And the answer is some projects in modernization are large projects. In particular, there are large projects in relation to infrastructure projects that now governments or local authorities decide to modernize as opposed to replace the whole thing. And for example, in North America, part of this drive by the current government has had a number of those, which then qualify as modernization because it's about replacing part of the escalator, replacing part of the lift, which of course the idea is that it causes less disruption to public traffic. And this is the answer. It's like, when you got these chunky things, they are so big compared to the base that then they result in this up and down peaks. Clearly, if we manage as we want to grow the base of those standard products, you will see less of these peaks. But at the moment, that's the situation.
Okay, great. That makes a lot of sense. Then secondly, just wondering about the previous indication on wage inflation. I think if I remember correctly, the indication was more than 100 million. Now, does that just pertain to personnel cost inflation, or does that include subcontracting cost inflation too?
No, I was talking about, indeed, north of 100 million. We talk about 140. That's actually what we foresee for the full year, and we are talking here about the wage inflation only. Yeah.
Sorry, I didn't get that acoustically. Which inflation only?
Wage inflation only.
Wage inflation only. Okay, so we have to consider subcontracting cost inflation as well.
That's correct.
And this goes, Martin,
Okay.
this goes into our margin. The subcontraction thing goes into our NI margins as part of cost of goods sold.
Right. That's helpful. And sorry, just for clarification here, there was this, there was the statement about EI margins being below group average. I presume when you talk about group average, you mean the group average EI margin and not the overall consolidated group margin, EBIT margin. Is that right?
Yeah, and it was for China only, the statement.
Right. I got that. But it's for the business area average and not for the group overall average, right?
Correct.
Perfect. Thanks so much.
Thank you.
The next question comes from Nick Housden from RBC. Please go ahead.
Yes. Hi. Thank you for taking my questions. I have two. The first one, hopefully just a quick one on China again. I was wondering if you could tell us what your the respective exposures are to sort of tier 1 and tier 2 cities versus the lower tier cities? Because just looking at the data, it seems like the property downturn is hitting the lower tier cities a lot harder than tier 1 and tier 2 ones.
Thank you, Nick, for the question. Allow me to split in two. We have 3 brands in China, and the way we are organizing those, and actually the way even they were originated, Schindler China is mainly tier 1, tier 2, very little presence in the more remote part, smaller cities. XJ Schindler, which is a larger dual brand, they are mainly tier 2, with some presence in tier 3, but mainly tier 2. Volkslift, that's the newest of a dual brand. They are basically tier 3 with some presence in tier 2. So we try to, and this is, I must admit, that works well in terms of coverage, but also in terms of product specs and combination to market. So all in all, as you know, most of our revenues today are generated by Schindler China. So then, without giving a specific percentage, I think that gives you some indication that our exposure to tier 2 and 3, or especially to tier 3, is by far smaller than to the rest of the urban environment.
Thanks. That's very clear. And then just on the net cash position and the interest rate environment. So you've got 2 billion of cash on the balance sheet. I think actually a little bit more. And it seems like in the coming months, maybe for the first time in a while, you can actually start to earn some decent interest on that cash. I guess it kind of depends which countries the cash is parked in. But I mean, how should we be thinking about the impact that rising interest rates could have on, say, net profit or the interest income? Will there be a clear net gain, or will there be sort of correspondingly large increases in the interest expense?
So let me, very good question. Indeed, we do have cash. Maybe Carla can add. But our approach, and I think this is public, is that we repatriate with a system of dividends, I think, cash to Switzerland. So the discussion is how do we allocate, and then of course leaving enough cash in the operations that they can run the business. This has always been our approach. So as you know, the interest rates in Switzerland now are slowly emerging from the negative interest rate area. But as some of your colleagues here who are from Switzerland can confirm, we're not yet into a very, I would say, high returns on interest on Swiss bank accounts. That is progressively shifting. So in other words, we definitely are looking at an improvement, but at the moment, there is nothing extraordinary coming.
Okay, that's very clear. Thank you.
The next question comes from Miguel Borrega from BNP Paribas Exane. Please go ahead.
Hi, good morning, everyone. Thanks for taking my questions. The first one, just going back to slide 7 on the high margin intake. Is that already being influenced by what you think will be a higher margin from modular? In other words, are you estimating a higher margin because these will mostly come from modular, or is it the point of the chart to show higher pricing? And following up on that, can you give us some sense of the gap between a normal order today versus modular? Is that 1, 2, 3, 4 percentage points difference? Some color there would be great. Thank you.
Yeah, thank you, Miguel, for the question. Let me just say, let me answer this, put it in perspective. Modular today essentially applies to what we call our residential mass product. Traditionally, these products always had a higher margin than the mid-rise and the high-rise. So, and part of our issue is that because of the issues that we presented, this new generation of modular unfortunately didn't add the impact we expected. So what is the idea is that now progressively, now as these issues are resolved, we want to reestablish the margins in residential that we always used to enjoy. So I'm talking about margins that are superior, by a certain dimension. I don't think we never revealed exactly what a different margin is per unit, but this is really key for us to reestablish profitability in new installation and ultimately for the whole product. So this is the approach. So in this chart, it is basically the effect comes from this modular product line and the improvement in the margin that get there simply by sheer size. The other ones are usually more bulky product, and there I must say the margins are, except for the issued supply chain, are somehow unchanged. But the biggest impact we had today was indeed in improving that. Does that answer your question?
That's very clear. Thank you. And then can you just talk a little bit about wage inflation and help us understand what percentage of the business would be a pass-through and what is today, as far as visibility you have in the business, what would be the headwind for 2023, and how much would that need to be covered by the price-cost spreads? Thank you very much.
Okay, so for 23, I'm afraid, Miguel, I believe it or not, certainly we're working on that now. So I suggest maybe, if you don't mind, we park this question for February. Maybe in terms of which business is the most affected. In service, in fact, most of our contracts have an escalation clause. So you cannot. It is not true in every country. For example, typically the US, which is a very high value country, doesn't have that escalation. So there are pockets of service where there is an exposure, though you can actually then increase prices in a more flexible way. But overall, by and large, I would say in service, the exposure is hedged. Where you have an immediate risk, for the industry, is on the new equipment. And that's why I raised this word of caution when presenting the slide, specifically on wage inflation, because there, as we discussed for raw material, the escalation is not always enforceable depending on you are. Inflation clauses are often related to material rather than wage. And of course, there is a topic of the backlog sold at a certain wage level and what the impact could be. So this is for us today the biggest, one of the biggest concerns we have. I must be very open, and I can see your question suggests you see it the same way.
Great. Thank you very much.
Thank you.
The next question comes from Joel Spungin from Berenberg. Please go ahead.
Hi. Good morning. Thanks for taking the questions. Maybe I can just start with a relatively simple one, which is I was just wondering if you could tell us what the revenue growth rate for the third quarter, specifically by region, was, just to give a bit of color on that. Obviously on slide 25, I think you give the 9 months with the blobs there. But I was just wondering if you could just break that out specifically for the third quarter.
Carla, would you like to give some indication?
Yes. If you just look, at a breakdown from the region, then it is clear that the Americas and Asia Pacific, but obviously excluding China, I must say EMEA, they are actually all three contributing at a similar level. Yeah.
Okay. Can you say what that level is, roughly?
Yeah, that is like, mid-single to high single digit, that they contribute. And obviously China is the exception, with the lower single digit growth there.
Understood. Okay. Thank you for that. And then maybe just second question, just coming back on the last question, actually, on wage inflation. Oh, can you hear me?
Joel, sorry, go ahead. Sorry for the question.
Hi. Yeah.
The line is. Are you still there, Joel?
I am.
Go ahead, please. Can you repeat your second question? Apologies.
Sure. Yeah, I just wanted to ask with regards to just adding to your previous comments around wage inflation, the 140 million. Is it possible to say sort of broadly, how much of that applies to the NI business as opposed to the service business. Is that something you can give a bit more color on?
Right. Carla?
Yeah, I would say it's around a third, two-third. 1/3 NI, 2/3 EI. Because EI is obviously the more heavy labor part of our business, right?
Great. Thank you for that. And then maybe just very quickly, in terms of subcontractor costs, can you say roughly how much that is? And is that predominantly, I assume, going into new equipment installation?
Yeah, we estimate that around 30 million for the full year.
And this is predominantly NI and modernization, because in existing installation, we work with our own workforce in all markets.
Got it. Thank you very much.
Thank you. We have time for a last question, maybe?
The last question comes from Daniel Gleim from Stifel. Please go ahead.
Yes, good morning, Carla, Silvio, and Marco. You mentioned the 25 physical maintenance visits a year in China and your expectation to convert this to remote monitoring down the road. Could you elaborate on that expectation? I'm especially wondering about the potential timeline and the extent of conversion. That's my first question.
All right. So, thank you, Daniel. The line wasn't great, but let me see. Do you refer to the China opportunity in terms of connectivity and conversion? So, as you may know, the Chinese government is running pilots as we speak. Actually, they've been doing that. They started doing it before the COVID started, and the idea was to have these pilots completed within, I think, a period of, I think it was 18 months, to be precise. Now, because of the COVID situation, there was uncertainty thrown in terms of timing. But the idea of these pilots is really to replace these physical visits that Marco referred to with remote visits. Now, there is a specific request that then the connectivity would not only be between Schindler and the customer, but also the local government would also have a side access in view of what they say is their concern to monitor safety of these equipments. I must say we've been trying to get answers, or because we have been, it's not only us. I think most large players have been involved in these pilots. Based on latest information that we've been asking our Chinese colleagues to provide us with, no decision has been taken as to when they become completely effective and actually becoming full scale. As you can imagine, we're very keen for this to happen, for all the reasons I mentioned, starting with safety, quality, but also efficiency and differentiation versus our customers. Now, at the moment, these pilots are done not nationwide, but by city. So, ideally, the conversion would then be that as soon as this is open, city by city, this will start. But I have to say, I love to have a figure on this, but at the moment, it is not in our hands. So it's really not for the lack of not wanting to give a number, but I don't have this number. But what I can tell you is the day it starts, because of portfolio connectivity, we are ready. We were the first ones to go in China, and I think in our portfolio, we are in China definitely ready, but I cannot tell you how. So all we need is the green light.
Very clear. A very quick one, if I may. Do you plan to provide quantitative midterm targets at some point? What I'm referring to is above and beyond the narrowing of the gap on margins versus competitors. And if yes, at what point in time could that happen?
I think we should I understand your question. I think we would if you allow me, I'll park this for when we speak in February. At the moment, there is so much uncertainty around that I think I'm not prepared. I'm not in a position to give an answer to this. But let's address this question again when we speak again in February.
Very clear. Thank you all.
Thank you.
Thank you very much for attending this call today. We would like to close now. Please feel free to reach out to me in case you might have any questions. The next presentation will be on February 22nd in the year 2023. Thanks again. Take care and goodbye.
Ladies and gentlemen, the conference is now over. Thank you for choosing Chorus Call, and thank you for participating in the conference. You may now disconnect your lines. Goodbye.